If you have been trading Forex and you feel like the market is always moving against you, entries look perfect, then boom, the market will not hit your stop loss. After that, price will not go as you predicted. Let me tell you something important. You're not stupid and the market is not random. We are just playing the game the wrong way. Today, I'm going to explain smart money concept in the simplest way possible. No big grammar, no confusion, no pretending. By the end of this video, you will understand how big banks move the market, why retail traders always keep losing, and how you can finally start seeing price differently. This is a beginner guide, so relax. Let's start from the foundation. First of all, we'll start with what is smart money concept. Now, smart money simply means big institutions, banks, hedge funds, big market makers. These guys don't trade like you and me. They don't press the buy button because of the RSI said oversold. They move huge money so they cannot enter what randomly. They need liquidity, and guess who provide the liquidity for them? Us, with the retail traders. Now, every time you place a stop loss, a pending order, or a trade obvious pattern, you are basically telling the banks where your money is hiding. Now, let's talk why most traders lose. Now, retail traders are taught things like buy at support, sell at resistance, trade line breakout, indicators confirmation. But the problem is everyone sees the same thing. And when everyone's buy at the same place, smart money sells to them. So price need to do what? Take everybody out, clear liquidity. That is why price breaks support, then goes up, or break the resistance and crashes, hit your stop loss and reverses. It is not manipulation, it is liquidity. Engineering. Okay guys, so now let's talk about liquidity. Let's use a chart example to explain liquidity. Now, the main core points of explaining liquidity, we are going to say we are going to use our equal highs and equal lows. This particular area or aspect is more active in the aspect of liquidity. Now, what do we have, or what are our equal highs or equal lows? When price starts moving up like this and suddenly produce the same highs with this former one, this is a high and this is a new high in the same area, this is called our equal highs. This is our equal highs, and liquidity is said to be resting in this particular place. People fell so much for this particular trap. They see equal highs and they might thought that this is a change of character. Not knowing that price might do something like this. Take them out. Take everybody out here and continue going down or continue going up. Because seeing this as a change of character, so many people will place their entry, let me say, in between any fair value gap over here. That will be the entry of some people, and their stop loss should be above this equal high or equal low. That is where their stop loss should be. And you see what price did? Price will sweep all of them out and start going in a peaceful direction, making them to lose their ad-end money. So now, you learning about how equal highs and equal lows work will teach you or will upgrade your aspect in trading. Now, the main key points in the aspect of equal lows and high is where you were able to input your stop loss, your buy order or your sell order. Where are you going to input them? That is the main core this thing, you understand? So now, if, like for example, this is a liquidity hunt, this is our equal highs and equal lows, this is our two equal highs, where are you going to put your stop loss? You do not put your stop loss. You wait for market to first of all sweep liquidity before talking about entering the market, talk less of inputting your stop loss. This is a liquidity grab. This here, this particular movement is a liquidity grab or a stop hunt. Let me show you that in a real time. Now, in this scenario, this is our equal highs. No, in this particular aspect, we have equal lows, not high. This is our equal lows. These two aspects From this candle here to this candle is an equal low. Now, some of you guys might be expecting to start buying from this candlestick here. You can see this is the other block here. Some of you guys might be expecting to start buying from here. Remember what I said about other block? The last bullish or bearish candlestick before an impulsive move. This is our other block here. Some of you guys might be setting in your entry here and your stop loss below this high or below this low, not high. That should be where your stop loss should reside because of too much of to avoid risking. Yes, this is what newbies will be doing, and their TP should be here. After setting something like this, they'll be happy. Yes, now this market is going to move in their favor. Yes, it's going to move in their favor, not knowing that they will be the one that is going to lose. You will lose from the market. You're going to lose from the market because the market is not in your favor like this. Now let me show you something. As a professional trader, you know what you do? You analyze the overall market. This is our equal lows, and this is also another equal lows. These two here is another equal lows. Liquidity are residing below them. But what are you going to do in a scenario like this? Because it's unrealistic for you to wait for price to come down here before trading. It's unrealistic, you understand? Because how are you going to wait as a day trader? So what you need to do is you pick up a Fibonacci tool, you measure from this particular place to here to know the premium and the discount area. Then after seeing something like this, you're going to be looking for your buy entry inside this particular place. Now you can see these two equal lows. They formed in this particular area, which is not acceptable. You're going to wait and look for your entries down here, which we can see a favorable gap over here. And that is going to serve as our entry for us, the professionals. But newbies will be entering from here. Let's see who's going to hit stop loss or TP first. The professional traders, you're placing their this thing there, the entry there, giving them a minimum of 1:2. Stop loss below here, giving it enough chance. But look at this newbie. Now let's watch. Now price took out this particular area, sweeping liquidity and tapping into this fair value gap over here before going to the right direction. Now this is all I have to say about liquidity grab and liquidity hunt. Now let's talk about market structure, the backbone of SMC. If you understand market structure, you already understand 50% of smart money concepts. Market structure answers one question: who is in controls, the buyers or the sellers? In an uptrend, you see something like higher highs or higher lows. In a downtrend, you see something like lower low or lower high. But here is the smart money twist: we don't care about trend lines, we care about break of structure. So now we'll be talking about break of structure and market structure. That is what I'm going to be talking about here now. So now, firstly, we are not going to talk about market structure if we're not talking about higher highs, higher lows, and lower highs. We're not using illustration. We're going straight to the market to know if we're going to see any examples of the illustration of what we are seeing. Now this is our series of lower lows, because as you can see here, price is in a downtrend, moving down. And for price to be in a downtrend, price need to be creating a lower lows, lower high, lower low, lower high, lower low, lower high, and so on and so forth, going down. That is what price need to be creating for us to know or accept the fact that we are in a downtrend. And now can we identify it here? This is our latest high, and this is our latest low, lower low, lower high, lower low, lower high, lower low, lower high, and so on and so forth. I'm not teaching you guys how to trade with this strategy, okay? I'll teach you guys, I think, in the next video or at the end of this particular video. But I'm not showing you guys how to understand market structure. So market structure consists of three factors. The price is creating a lower low like this and keep going down. You can see something like this, and this particular one, they look the same. Understand? They look the same. What is happening here? Downtrend. What is also happening here? The same downtrend. You understand that, Abi? You understand? So now on that series we have is if price is ranging. Now like something like this, I think price is ranging here. Price is just ranging here without breaking, making any move. This is a ranging market. This particular area here is a ranging market without making any potential move. Price will just be ranging from here to here. Down here, this is a ranging move from the market. Market is ranging, and again, if price is giving us a series of higher high, higher low, higher high, higher low, higher high, higher low, that is we are in a uptrend. Now remember, the latest high should be bigger than the new high should be bigger than the latest high. This is the latest high, and this will be the new high, and it's bigger than this one. A new low, a new high, a new low, a new high. Seeing this shows that market is what? In a uptrend. This is also a aspect that market is in a downtrend. Higher low, higher low, lower high, lower low, lower high, lower low, lower high, and so on and so forth. Remember that market structure tells you the buyers if the sellers are in charge or if the buyers are in charge. Now to get a clear structure, you need to go into your 4-hour time frame. Now in your 4-hour time frame, what do you have here? I was running my screen. These are 4-hour time frame. Who is in charge? Who do you think is in charge here now? Tell me, who do you think is in charge here? We're in a bullish form. How are we in a bullish form? Because market is creating, this is our lower high and this is our higher high. This is our lower high and this is our higher high. Lower high, higher high. Okay, so now after creating this, what do you expect from markets? To keep on breaking structure to the upside. This is a break of structure to the upside. This is a break of structure again to the upside. So if price is creating lower lows or lower highs, price is doing what? Breaking structures. Example here, this is a break of structure to the downside. Another break of structure. Another break of structure. This is it. And after all these break of structures, let me label them. This is it. Now, this is what I meant by the lower highs and lower lows. Breaking structure to the downside. This is what called market structure. This tells the buyers. So now in this particular market, who is in charge? The buyers or the sellers? I think the sellers are no more in charge, but the buyers are fully in charge. Seeing this latest break of structure to the upside, the buyers are fully what? In charge. As simple as that. And let's talk about change of character. This is where beginners level up. Change of character means the market is no longer behaving the same way. For example, the market is now making higher highs. Suddenly, it fails to do so, then breaks a previous low. That is not random. That is smart money changing
Now,
direction.
we'll be talking about change. We'll be talking about change of character. What is the change of character? I'm giving you guys a few seconds to think. What is a change of character? Now, listen, let me tell you guys. A change of character simply means, as I said earlier, that the market is no longer behaving the same way. The market is now changing from an uptrend to a downtrend, or from a downtrend to an uptrend. The market changing direction is what we call a change of character. For someone to change his character, if you're a good person, you'll be doing one particular, you'll be doing good to people, but suddenly you changed character and start doing bad. You do not change character twice, you change it once. Once you have changed the character, you have changed it once to the bad side and start committing bad atrocities. If you are tired of committing that one, you change again once and you go back to a good character. This is what we are seeing in the market in the chart below. This is a clear example of what I just said. Now, this is our break of structure to the downside. BOS, a break of structure. This is showing that the sellers, from here, this shows that the sellers are in charge. Break of structure to the downside. A new one. To the downside. Another new break of structure again to the downside. Another break of structure to the downside. And all of a sudden, we have our change of character. You can see it. This now changed the motion, that price is no longer moving in a downside, but now changed and started moving, or starts moving in the upside. We are no longer moving in the downside anymore. We are now moving in the upside. Change of character. After creating a change of character, what follows? A continuation of that particular character that is being changed. Now, after creating this change of character, we can see a continuation, and this continuation will be referred or seen as a break of structure. Do you understand? This will continue to be our words, as I said earlier, break of structure. If eventually price decided to continue or change character to the downside, you see something like this, and boom, you just break this low. This is the change of character now to the downside, and price continue going down, and all of a sudden price starts wondering that it's tired of going down and it wants to start going up. You see something like this, equal eyes, or you just see something like this, and the next thing you see is boom, change of character from here, and price will start doing what? Going up. This is a change of character.
Now, let's talk about the most popular SMC concepts, as we said earlier, order blocks. An order block is simply the last bullish or bearish candle before a strong move. Simple. That candle represents institutional orders. Banks don't enter once. They enter in phases. So when price comes back to that zone, they defend
Now
it.
let's talk about break of order block. As I said, order block is the last bearish or bullish move before an impulsive move. In my latest video, if you check my page, you see I treated this order block there, so no need elaborating too much on it. If this is price moving in a normal range, and all of a sudden you see something like this, boom, where are you going to mark as your order block? Here. This is your order block. Chicken. That is other block. So no need to go straight or to frustrate or teach more about it. Now this is our chart here. Where's our other block? This is a positive move to the upside. This is our other block here. Simple. This is our other block. Let's keep finding other blocks. Other block. Other block. What I marked here is this bearish movement, this black candlestick, not that blue one, and so on and so forth. This is our other block. The last candlestick before the bullish move is called our other block.
Let's talk about fair value gap. You see, price move fast when it's insufficient. That imbalance is called fair value gap. Smart money likes price to come back and rebalance it. That's why price often explode, pulls back, then continues.
Now, our fair value gap is just a range or an imbalance that always constitutes between three or more candlestick. Now, look at this particular place. Number one candlestick, number two candlestick, number three candlestick. All of them doing what? Moving in one direction. You can see it here. All of them moving in one direction. Now, this candlestick leaves traces behind. From this particular man here to this particular man here. Inside there is our fair value gap. Inside there is our fair value gap. That is what we call a fair value gap. That is what we call a fair value gap. Now the same thing goes to here. From this man here, one candlestick, two candlestick to three candlestick. Yes, our FVG lies in between them. This is it here. From here to here. That is our fair value gap. So fair value gap does a scenario in between three impulsive big move candlestick, just like that. That's where we're going to see our fair value gap. It must not be big, you understand? It must not be big. This is a move. What's going on? Okay, this is a tiny candlestick, impulsive movement. This tiny is the other block, impulsive movement, and this under impulsive movement. Now from here to here is what? Our FVG. FVG is not rampant. You can see it, you cannot see it. Some are tiny, some are not tiny. From here to here is under FVG. You have so many FVGs, you understand? We have buy side FVG and sell side FVG, and so on and so forth.
Now, let's talk about our entry model. It's a beginner friendly. Let me simplify entries for beginners like you guys. Now, you need three things only: your bias, that is the market structure, liquidity taking, your entry at discount or premium area, no rush, and what? No over trading.
Now, in this particular aspect, I'm going to teach you my simple entry model. Very simple. Step one, we're going to identify the trend, the market trend, if we're going up or down. Step two, we're going to wait for a liquidity sweep, which is a must. Step three, we're going to make our entry on other blocks or FVG, fair value gap entries. Step 4 should be our stop loss below or above any structure, while our take profit should be the opposite liquidity. Let me illustrate it before showing everything to you guys. First of all, if this is the market trend, what are we doing? Are we going up? Are we going down? We are going up. We are going up, Abby. Yes, because break of structure to the upside. Break of structure to the upside. Break of structure to the upside. Going up, looking for an opportunity. This will be our other block over here, because our other block is the other candlestick that causes this particular impulsive move that break this particular structure. That will be our other block, or our fair value gap should lies in between here. You understand what I mean? Now, we cannot just wait for price to go down in, our entry should be here. Stop loss here. TP here. We cannot just wait for price to go down something like this and tag us in and start going up. This, if you allow price to do something like this is just a 50% chance because there's no liquidity here. You might be the liquidity. You are lucky that price did something like this because you might just be the liquidity. Price will sweep you out, tag you in and sweep you out before going up. You understand? You might just be the liquidity. So all you need to do is for you to wait for market to form its own liquidity, create liquidity, sweep that liquidity and continue moving. Something like this. Price to start doing something like this, creating a double or equal highs or equal lows. This is called liquidity. And price will now do what? Sweep that liquidity and go to your directed area. This is my simple entry model. You can see how I defined it. The trend is a bullish movement. This is our liquidity sweep, and this is our entry. Our entry from the other block. Our stop loss is below this particular low, and our TP is above the particular liquidity range over here. Now let's see that in a clear market scenario. Now looking at this particular chart, what do we have? You can see we are in a downtrend. We're in a downtrend. This is a downtrend. Break of structure. Break of structure. Another break of what? Structure. How should we enter? Do we start selling because price is already in a FVG created? Should we start stacking ourselves from this particular man here? No. We do not do something like this because price is going to sweep us out and we're going to lose our money. So what are we going to do? What are we going to do? We need to wait for price to create its own liquidity, which it did already. This is the liquidity here. This is our liquidity because so many people start entering here and their stop loss will be above here. So this is our liquidity here, and this is our other block here. You see this last bullish candlestick. Let me show you very well. This candlestick here, this one here, that's our other block. All we need to do is wait for price to tap us in that other block, and we are out, and we are in, we are out, as fast and easy as that. Let's define everything again. What is our structure? Help me guys, recite after me. What is our buyer structure? We're in a bearish form. Break of structure, break of structure, break of structure. Now what is after break of structure? What next again? Liquidity. This is our liquidity over here. Price is going to sweep this liquidity and tap us in. After liquidity, what else do we say? Our entry, which is this is our other block as our entry. We're entering from the other block, not the fair value gap. After that, again, your stop loss must be defined. This is our stop loss. Our stop loss will be above here in case price wants to clear the stability here. Our stop loss will be above there. Now let's define our TP, as TP also should be below here. This should give us a 1:2.30, 2.40 reach to what ratio? 2.40 reach to what ratio? Yes, as easy as that. This is all we need for a perfect entry and a perfect movement. You can see it, guys. TP entry smashed and our TP it's as easy as that. Some of you guys might see something like this and be scared. Don't be scared. Once your analysis is correct and everything is correct, the market will dance in your favor.
Now, here a common mistake that beginners does. Let me save you months of pain. Firstly, do not trade every other block. Do not ignore higher time frame. Do not enter without liquidity sweep. Do not over leverage. You understand? So SMC is patient trading. In conclusion, smart money concept is not magic. It simply teaches you how the market actually works. Once you stop thinking like retail trader and start thinking like institutions, the chart will never look the same again. If this video helped you, like and subscribe. The next video, I will teach you a full SMC trade from start to finish. No skipping. Trade smart and stay disciplined. I remain OLUWA-POUNDS.